For the last 2 years, you've been told the same story. Rates are coming down. Your mortgage will get cheaper. Refinancing will finally make sense. That story just quietly flipped. Right now, more people on Wall Street are whispering about the Fed's next move being a hike than a cut. The opposite of what almost everyone has been planning around. And whether that happens or not, the machine that decides it is the same $140 trillion plus market that already prices your mortgage, your savings account, and your retirement. A market most people have never looked at once in their lives. By the end of this video, you're going to understand exactly why this is happening, and, more importantly, exactly what it costs, or saves you, in real dollars. This isn't abstract. If you've been waiting to refinance, if your savings account is paying you next to nothing, or if you've ever wondered why your safe retirement fund actually lost money a few years back, this video is built around exactly those three problems, in that order. This all comes down to one market, the bond market, and it is not complicated. What makes it powerful is scale. A bond is a loan. A government, a company, or a city needs money, and instead of going to a bank, they borrow it directly from investors. From you, potentially. You hand over a fixed amount called the principal. In return, you get two promises, a fixed interest payment every year, called the coupon, and your principal back on a specific date, called the maturity. That's the entire instrument, a piece of paper that says, lend me money now, I'll pay you interest every year, and I'll return your principal on this date. The US government alone has borrowed more than any government in history. The national debt currently sits above $37 trillion. The interest on that debt alone is now measured in the hundreds of billions of dollars a year, paid for entirely out of tax revenue, at a rate set by the exact same market that's about to decide your mortgage. Here's the single rule you need to make sense of everything else in this video. When interest rates rise, the price of existing bonds falls. When rates fall, bond prices rise. Always, without exception. Say you buy a $1,000 bond paying 3%, $30 a year. A few months later, new bonds are issued paying 5%, or $50 a year on the same $1,000. Now, you want to sell yours. Nobody pays full price for a bond paying less than the going rate, so the price has to drop, until that same $30 works out to a competitive yield. At 5%, that price lands around $600. You haven't lost a single future payment. The bond still pays what it always promised. But on paper, your $1,000 is suddenly worth $600. Every single thing that happens for the rest of this video is that one rule playing out at a larger scale. Now, here's where this stops being abstract and starts being your mortgage. The single most important bond in the world, for your life specifically, is the 10-year US Treasury, right now yielding around 4.5%. When a bank prices your mortgage, it isn't inventing a number. It looks at that 10-year yield and asks, why would I lend money to a household for 30 years when I could lend to the US government, essentially risk-free, for 10 years at 4.5%? The answer? It wouldn't, unless you pay more. So the bank adds roughly 2 percentage points on top to cover the extra risk that you might lose your job, get sick, or default. Take the 10-year at around 4.5%. Add that spread, and you land almost exactly on today's national average 30-year fixed rate, sitting around 6.4% to 6.5%. Let's make this concrete. Say you take out a $400,000 30-year fixed mortgage at today's rate of 6.43%. Your monthly principal and interest payment comes out to about $2,510. Now imagine, the 10-year yield rises half a percentage point, a completely routine move the bond market can make in a single trading week, especially with a hawkish Fed in the room. Your mortgage rate rises by roughly the same amount, to about 6.93%. Your new payment, around $2,643. That's $133 more every single month for 360 months. About $48,000 more over the life of the loan, from a move you had no part in a market you've never opened an account with. If the 10-year moves a full point instead, again, routine, your rate climbs to roughly 7.43%. Your payment becomes about $2,778, nearly $270 more a month, and close to $97,000 more over 30 years. And zoom out further. In January 2021, the 30-year fixed hit an all-time low of 2.65%. On that same $400,000 loan, your payment would have been about $1,612 a month. At today's rate, the identical loan costs you about $2,510 a month. Same house, same buyer, same loan amount. Just a different day on the bond market. The gap, almost $900 a month, or roughly $323,000 over the life of the mortgage. Nobody sent you an invoice for that. The bond market just quietly wrote it. And this isn't some far-off hypothetical. There are 2 dates on the calendar, right now, that could move every number you just heard. The Fed's next rate decision lands July 28th to 29th. Before that, the June inflation report lands July 15th. Energy prices have been climbing. Inflation has been stickier than expected. And for the first time in a while, more traders are pricing in the possibility of a hike than a cut. The Fed doesn't directly set your mortgage rate. The bond market does that. But a genuinely hawkish surprise from the Fed is exactly the kind of shock that can push the 10-year yield up fast. And every dollar figure you just heard would move with it. This is why understanding this market isn't optional trivia. It's the difference between watching your rate move and understanding why it moved. For decades, the standard advice for anyone approaching retirement was simple: shift out of stocks and into bonds as you age. Bonds were sold as the seatbelt. Stocks grow your money, bonds protect it. In 2022, the Fed raised rates faster than at any point in roughly 40 years. Apply the one rule from earlier: rates up, bond prices down. The broad U.S. bond market had its worst calendar year on record, going back to 1976, and a classic 60-40 stock and bond portfolio, the supposedly conservative default, still lost around 16% that year. The seatbelt didn't catch anyone. It was attached to the same crash. The further out a bond's maturity sat, the worse it got hit. Long-dated treasury bonds, the longest duration safe assets that exist, lost close to 40% that year. One historical analysis found that was the worst year for long-duration U.S. bonds in over 2.5 centuries. Not a typo. Before the country existed. There's a single number that explains why some funds got crushed and others barely flinched: duration. It's printed on every bond fund's fact sheet, and almost nobody reads it. Duration roughly tells you how much a fund loses for every 1 percentage point rise in rates. Say someone has $500,000 in what they believe is a safe bond fund. If the fund's duration is around 6, typical for a broad bond index, a 1-point rate rise costs them about $30,000. If the duration is closer to 17, typical for long-dated treasury funds, that same 1-point move costs roughly $85,000. Same person, same $500,000, same rate move. A $55,000 difference based entirely on one number. Most people never open the fact sheet to find. If you hold an individual bond to maturity, none of this matters. You collect every coupon and get your principal back, regardless of what the price does in between. A bond fund is different. It never matures. It's repriced every single day, and those losses land on your statement and stay there. So if bonds aren't automatically safe, where does actually safe cash belong? Right now, here's a number that should genuinely annoy you. The national average savings account at most of the country's largest banks pays around 0.38%. Meanwhile, 3-month Treasury bills, backed directly by the U.S. government, are yielding somewhere close to 3.7% to 4%. The best high-yield savings accounts, FDIC insured up to $250,000, are paying somewhere around 4.2%. Same safety, dramatically different return. On $50,000 at 0.38%, you earn about $190 a year. At roughly 3.7% in T-bills, that same $50,000 earns close to $1,850 a year. Nearly 10 times as much for identical risk. Leave it at the average bank instead, and over 5 years, you've quietly given up somewhere in the range of $8,000 in interest. You could have collected without taking on a shred of additional risk. If inflation staying elevated worries you specifically, Series 1 savings bonds from the U.S. Treasury adjust with inflation directly, currently paying a composite rate above 4%, with a $10,000 per person annual limit through Treasury Direct. It's one of the most direct inflation hedges available to an ordinary saver. One more piece, worth understanding, because it predicts the economy better than almost anything else public. The yield curve. It's simply the plotted yields on Treasury bonds across every maturity, from 3 months out to 30 years. Normally, that curve slopes upward. Longer loans demand more compensation because more can go wrong over 30 years than over 3 months. Occasionally, it inverts. Short-term yields rise above long-term ones. When that happens, the bond market is making a specific prediction. It expects the Fed to be cutting rates within a year or two because it expects the economy to slow down enough to force its hand. According to research from the Federal Reserve Bank of San Francisco, every one of the last 10 U.S. recessions, going back to 1955, was preceded by an inverted yield curve, a 10 for 10 record, with no other indicator that comes close. Right now, with the Fed's tone shifting hawkish and yields climbing on inflation concerns, the curve's shape is worth watching over the next few months. Not because it predicts everything, but because it's telling you something about what the market as a whole actually expects days or even weeks before it shows up in the news. The bond market isn't something rich people do. It's the invisible machinery that already prices your mortgage, your savings account, your retirement fund, and the job market your employer operates inside of. Every dollar in your financial life touches it, whether you've ever looked at it or not. The people who understand this aren't smarter than you. They just stopped assuming it was too boring to learn. If you want to know exactly where your own mortgage, savings, or bond exposure sits against these numbers, drop your rate or your balance in the comments. I'll walk you through what it means. If this connected some dots for you, subscribe. We run these exact numbers every week, especially with 2 major dates on the calendar this month that could move all of it.